Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to the Bloomberg Daybreak Asia podcast. I'm Doug Krisner, and today we begin in the oil markets where prices are soaring. This escalating tension in the Middle East has prompted the U.S. State Department to reportedly order American workers at the U.S. diplomatic mission in Saudi Arabia to leave. The New York Times reports it's an indication that senior U.S. diplomats are bracing for a possible surge in violence in the war with Iran. Now, major producers like the UAE and Kuwait have reached storage capacity, and so as a result, they're now reducing production, joining Iraq, which has already cut output down to about 60%. And at the same time, the most important waterway for global energy markets, the Strait of Hormuz, is essentially closed. Joining us now is Bloomberg's Paul Dobson. He is executive editor for Asia Markets. Paul joins from our studios in Singapore. Thank you so much for being here. This surge in oil prices has sparked some heavy selling in Asian equity markets, and the losses are quite dramatic, aren't they?
Well, I think that the situation has definitely become more tense over the weekend as far as market watchers are concerned. We have Iran appointing Khamenei Jr. as the new leader, which doesn't suggest any sort of a pivot away from a kind of hardline policy. We have signs of more production getting shut in the Middle East region because it can't get out of the Strait of Hormuz as well. And so that's leading to those sort of knee-jerk fears of scarcity of oil supplies in some parts of the world, at least blockages in the refinery output, which is also pushing up the likes of jet fuel, diesel prices. And the fear that that creates is twofold. On the one hand, the inflationary fear, because higher oil prices will push up costs right the way through the economy. And secondary, the fact that that will slow down growth as well. So it's not just inflation, but stagflation that people are worried about, especially after the non-farm payrolls number that we had at the end of last week, which was deeply negative and troubling when people had been assuming that the US economy was still holding up relatively well.
So last week when we saw that massive sell-off in the Kospi, I think at one point we were down 12%. A lot of the thinking was that this was the result of forced liquidation because margin calls had gone into effect, and rather than pay into those accounts to bring that level of equity up to the required level, you just were forced to liquidate a position. Is that playing out again, do you think, today?
I'm sure that there will be the risk of that again. Yes, the Korean traders love leverage. They love risk, and they don't stop. They, certainly bought the dip in decent numbers after that sell-off that we saw last week. And so the fact that there's another down day may again lead to some traders hitting margin limits and being forced to either put up more collateral or cut their positions. And I think that it's probably the same across Asia today, because levels of implied volatility are likely to rise with the big moves that we're seeing in all markets. That's going to lead to more demands for collateral across the whole investment complex, which will again cause people to seek to liquidate not just the sort of holdings that have done well already, but also the most liquid ones. So that may be adding to the downward momentum on things like bonds, for example. Very
difficult to find a haven in today's session. I mean, U.S. Treasuries, which are normally considered to be a haven, not the case today. To go back to the point that you just made about rising inflation, that's being reflected in U.S. bond yields. We have the precious metals that are showing weakness. I think spot gold is down around 2.5% as we speak. Silver more so. The only thing that seems to be positive at the moment is the dollar. Can you help me make sense of that?
The dollar has been performing well as that haven of choice during the turmoil that we've seen over the last week or 10 days, partly because of its deep liquidity, partly because of its relatively high interest rates and the idea that the Fed isn't going to be cutting anytime soon, and partly because as a net exporter of both oil and natural gas, the US is not in a completely disfavorable position right now, and relative to the rest of the world maybe looks a little bit better off in some respects. And so people are going to that as a kind of place where they would prefer to have their money right now. Partly, it's that cleanest dirty shirt kind of a thing that we've heard before, where if you look at the rest of the world, you think, well, where's better right at this moment in time, and so that's where the cash will tend to flow. And it's not, as you said, it's not the government bond market, but it's the money markets where the cash is basically sloshing around, kind of unallocated, basically.
I'm curious as to whether or not anyone is talking about private credit today in the APAC, because last Friday here in the U.S., we had shares in BlackRock down nearly 8% after the firm curbed some withdrawals from one of the private credit funds that BlackRock operates. You and I have spoken about this in the past, and I'm wondering whether or not it's even part of the conversation today or whether it's being obscured by everything that's happening in the oil market.
It hasn't really come across my radar particularly, but I think that the reasons for that are twofold. One, yes, obviously the noise from the rising crude oil prices is kind of cancelling everything else out at the moment. But also in Asia, private credit, not quite such a big deal as the rest of the world. And so therefore, as we move into the US day, maybe those concerns come up again as well. But what I will say is it certainly doesn't help with the bigger macro picture when we have that, plus the AI disruption worries that have been weighing on traders' minds in recent days and weeks, along with the backdrop of the crisis in the Middle East that we're seeing right now, creates a toxic cocktail for global markets.
No doubt about that. And I think one of the key questions at this point that's so far been unanswered is, what could the duration of this conflict be? Are people talking about worst case scenarios on calls today that you've maybe have been privy to?
I think what we learned over the weekend is Iran seems to be doubling down. When you look at the appointment of the leader, when you look at where the missiles have been going, for all that we heard a bit of an apology, it doesn't seem to have changed anything. The fact that a desalination plant was hit in Bahrain was seen as a negative thing if it means that more civilian infrastructure may be targeted. Israel hit some of Iran's crude oil infrastructure as well. And I think on top of that, we heard from Donald Trump in a tweet saying $100 a barrel oil for a short period of time is a reasonable price to pay in order to, secure the goals that the US has in Iran. So it also doesn't seem like he's immediately panicked by that move. So the idea, the thing that people have in the back of their mind, will the US president at some point retreat, having escalated, doesn't really sound like he's backing down right at this moment in time at all. And so that does make people concerned that there will be a much longer term war here. So I think that you have that on the side of pointing to longer conflict. I think on the flip side of that, you could say, well, if you look at the crude oil curve, it's still in very, very steep backwardation, which means the prices for the back end of this year are still down at about $70 a barrel, suggesting that people feel that once that this situation is resolved, the price of oil could fall off again quite rapidly.
So President Trump and Chinese President Xi Jinping are set to meet in the next couple of weeks. Do you have a sense of what this conflict in Iran may do to that meeting?
What I will say is that all the noise that we're hearing out of China, at least, has been very positive still in terms of the setup for this meeting. Talk about this being the start of a reset and a longer term kind of stabilization in relationships. So it doesn't sound like China is going to raise this as a particularly big issue or some reason that would in some way halt those talks, stop those talks from taking place. I think that there are some initial meetings planned to come up in the next couple of weeks as well to lay the groundwork for that. But so far, actually, the signs there as something of a thawing of a relationship. And I think that, if you look at what China's markets have been doing, they've been relatively well insulated, actually, from what's happened so far in Iran and the oil market and that tension. So it'd be interesting if, when you're talking about havens, whether actually China emerges as another place where people have relative confidence compared to some of the more excessive moves that we're seeing, for example, in Korea and Japan today.
What about the story in India? Last week we had reporting that indicated that Russia was going to be granted some privileges to be able to sell crude oil to India. Now, that had been a line that President Trump had drawn previously, pressuring Indian Prime Minister Modi not to buy any more Russian crude. He seems to have reversed himself, just perhaps temporarily, given what's going on, the ructions happening in the oil market. Do we know anything more about what's going on with India?
It seems like they were very quick to take advantage of that and to lock in some purchases of the Russian oil, which has been floating around on ships not too far away. So they're able to take some deliveries, which is very good news because they need to get those refineries running and to continue to have oil flowing through the economy. I think across Asia, there were signs at the weekend of worries in various locations that there may be fuel shortages. So not just the cost being the concern, but actually the availability. And so that at least provides a little bit of a relief as far as India is concerned at a quite important time of year for the economy in terms of the crop rotations. So that at least is one crumb of good news, but it also speaks to just how kind of crazy and mixed up this whole situation is right now, right, Doug? That, you have to cut off your nose to spite your face in a way by allowing some step back from policy in one conflict in order to paper over the cracks that have been caused by a conflict somewhere else.
You're absolutely right about that. Paul, thank you so very much. Paul Dobson, Executive Editor for Asia Markets, joining from our studios in Singapore here on the Daybreak Asia podcast. Welcome back to the Daybreak Asia podcast. I'm Doug Krisner. And now let's take a closer look at what those higher oil prices mean for economies in the APAC. Qian Wang is the chief Asia-Pacific economist at the Vanguard Group, and she spoke to Bloomberg TV host Haidi Stroud-Watts and Avril.
So I wonder, what is your take first at $110 a barrel of oil, which we are now within reach of? What's that going to mean in terms of the scenarios for Asian economies, both on growth and inflation?
Good morning. Thanks for having me here today. I think, in terms of the macro impact, there is no doubt that higher oil price is actually a stagflationary shock, to most of the economies. It's negative for economic growth and it's going to lift inflation higher. But I would say in terms of the actual magnitude of the impact, it also depends on how long the oil price will stay at the current level, right? So that duration of the higher oil prices actually matters as well. We estimate that, for Asian economies in general, because this region is particularly vulnerable because most of them are, rely heavily, if not entirely, on imported oil and also heavily reliant on the supply from Middle East. We do estimate that every 10% of increase in oil prices will lead to about, 10 to 20 basis points lower in GDP growth and 20 to 40 basis points higher in headline inflation. So the impact is indeed there if the higher oil price is going to last. But of course, I would say every country is different.
On that note, it's perhaps also worth unpacking. We know how consumers' fear of inflation can also tend to drive these price pressures. We're hearing in parts of Asia, people are lining up at pumps. What is that aspect going to mean for the pressures we see in prices?
Yeah, I think, there's direct and indirect impact, right? And I think what you're describing is also this kind of inflation expectation, that actually can push the prices further up. But, as I mentioned earlier, every country is different, right? Because I think, one, it really depends on whether the country has strategic reserves that can help to stabilize the domestic price. And two, I think it also depends on the government, whether they're going to intervene, right? Either through subsidy, tax cut, or there's different kinds of pricing mechanism in different economies that is going to limit the pass-through from crude oil prices to retail prices. And I think for Asia, the good news actually is that most of the economy actually at this moment experience low inflation. Right. And domestic demand is pretty weak. So on that front, I think when central bank looking at that, I don't think, high inflation is going to be their primary concern at this moment. So to that extent, I don't think they are going to react to the higher inflation by, aggressive tightening the monetary policy.
So to that point, do you think that it will be some time before we see a reaction from central banks in terms of how they tweak policy settings?
Well, I think let's put it this way, regardless what they plan to do, right? Either they plan to hike or cut. I think at this moment, all central banks are going to be more cautious with any move in the near term because of this heightened uncertainty, right? Geopolitical uncertainty, higher oil prices. I mean, obviously, stagflation and shock always going to put central bank in a very difficult situation. But given the uncertainty at this moment, I think their best strategy is just to wait a little bit, right? Wait for the dust to settle. So I think you do see last week, for example, central bank in Malaysia, they actually turned, more dovish. And then, like Singapore, right? We think they are actually the more hawkish one in this region. I don't think they are in a rush to tighten. Central bank in India and Korea probably will stay on an extended pause. And central bank in Thailand and Philippines, they plan to cut. We expect them to cut, but we also think they probably also will take a little bit time to observe what's going on before they, start the next cut.
When it comes to the PBOC settings and the Chinese government, we know that China has large exposure to Middle East energy, but are there also strategies and buffers in place there? Because we also know that they have pretty significant reserves.
Yes, I think, for China, we actually estimate the impact on economic growth will be rather limited, right? We only estimate about 5 basis points lower growth for every 10% of oil price increase. I think part of that is because China, one, as you mentioned, a strategic reserve they have been building over the past several years. And two, I think China really diversified the imports market for oil, right? So when we talk about Middle East, it's about 40% of China's total, imported oil. And the other thing is that in recent years, I think China also, was moving very aggressively with the green transition, right? So those green energy actually is now accounting for 20% of China's energy consumption compares to 15% in 2019. So I think all of that actually helped to alleviate some of the impact from higher oil prices. And I also would expect that yes, fiscal policy will actually be ready, right, to limit the impact on crude oil prices, the impact on households.
Aside from that energy security angle, talk to us also about the trade angle, given how the Straits traffic is pretty much halted. Asia's economies, many of them are, reliant on exports. Yes. I think, at this moment, this kind of global supply shock, right, it's going to a big, disruption potentially to the global supply chain, right? So what does that mean, for the global trade for the down the road? I think remains, something that we need to watch very closely. I think the hope at this moment for a lot of people is that this conflict could be rather short-lived, may not last more than a few weeks, right? Then in this case, I think the disruption to the global economy, global trade will be rather limited. But I think if the conflicts and also, what happens to the Strait of Hormuz, that actually sustain, more than just a few weeks, then I think the disruption to global economy and trade could be quite significant.
That's Qian Wang, Chief Asia-Pacific Economist at the Vanguard Group, speaking to Bloomberg TV host Haidi Stroud-Watts and Avril Hong, bringing you their conversation here on the Daybreak Asia podcast. Thanks for listening to today's episode of the Bloomberg Daybreak Asia Edition podcast. Each weekday, we look at the stories shaping markets, finance, and geopolitics in the Asia Pacific. You can find us on Apple, Spotify, the Bloomberg Podcast YouTube channel, or anywhere else you listen. Join us again tomorrow for insight on the market moves from Hong Kong to Singapore and Australia. I'm Doug Krisner, and this is Bloomberg.